So how did you first discover Ridley?
Yeah, so we were just looking actually at the agriculture space more broadly, just identifying where there could be exposures and opportunities, because it was on its nose a few years ago. It's on its nose every few years, I suppose. But then we came across Ridley, and it effectively gave us a lower volatility exposure to the agriculture space. And so went away, met the company, met them at a few conferences, had some one-on-ones with them, met some of their suppliers, did a bunch of research ourselves, and then came away pretty comfortable with it. And it was trading at a very attractive multiple at the time, so that's when we first bought it, effectively.
Nice.
And so for people unfamiliar with Ridley, what does it do?
Yeah, so simply they're kind of like an animal nutrition provider. So they take raw ingredients and turn it into feed for animals. So they've got their feed mill business, which is essentially taking grain for the monogastric market and the ruminant market, which is your pigs, chickens, cows, and that's kind of grain that has been put through a process whereby it has more nutrients, etc. And so they distribute that to farmers, or they essentially manufacture that for farmers. They then have their ruminant business, so their rendering business, and that is where they take offal, so the offtakes of butchers, etc., and they then turn that into animal protein. They then go back into their feed business, or another example of that is a canine food. So Woolies and Coles, their canine food is from the rendering business of Ridley's. So it's a pretty we've been to some of these facilities, and they're pretty gnarly at times. So what you see and what you smell, etc. But it's a really necessary part of our kind of like supply chain, and these guys are absolutely brilliant managers. And this is one probably even as much as your 2Rs kind of thesis that hinges on a very, very good management team. And they've just bought a business recently off Dino Noble, which is previously Incitec Pivot, before they changed their name, and that was a really smart acquisition. And so we see great opportunity for them there, and that's a ag chem distribution business effectively. Yeah.
And so then why is it a lower volatility exposure to agriculture? Because dogs always have to eat.
Well, more of that in a sense, but also if you think about it, when there's drought-like conditions and there's theoretically less livestock because people are culling because they can't afford to feed them all, they provide grain, right? So you need that product to feed your animals because you don't have the grass and all these other things. So it does provide a natural offset to that kind of lower volume at a market level, because there's a higher volume of grain adoption. And then of course the canine markets and things like that are more stable than your traditional boom and bust cycles in agriculture. So it does have volatility in its earnings relative to a SaaS business, of course, but we're talking agriculture here, and so it does have some offsetting factors that effectively diminish that volume risk. Yeah.
When we were preparing for this interview, we had a look at Ridley, and it had a bit of a tough start to the year, lost a key contract, the stock was down 20% between February and April. So take us into the room of Milford Investment Committee there. What was the conversation? Was there talk of getting out? How did you keep your conviction?
Yeah, well, I guess whenever a company has a challenge, right, you have to ascertain whether or not it's a structural or a cyclical issue with a business, because if it's a cyclical issue and you have high conviction that they'll be able to return to those previous levels of earnings, because that's the beauty of a cyclical theoretically, is you should be able to get those earnings back, but the multiple's cheaper. That's could be an opportunity. On the other sense, if it's structural and there's something more nefarious at play, that's ultimately the analysis you're trying to ascertain, is where does it land on that spectrum. And the example you gave on that contract, that was one of their feed mills where one of the customers was the vast majority of their volume, and that customer generally, once they get to a certain scale with their poultry farms, they own the feed mills around them. So you have this scenario where you could roll the dice. The contract was for another few years, and you could see if they stayed on or see if they went and built their own feed mill, or what they did was they sold it to them, and so they freed up capital. So they lost the contract in one instance, but they did free up capital on the other side of it. And in hindsight now, that makes a lot of sense, because obviously they then went and made that acquisition. So they were pretty happy. Maybe not happy, but at least that there was a quick use for that capital, which we kind of came to. So we essentially determined that some of the factors that were impacting the business, such as the avian flu issues, which meant that if other markets aren't buying some of our feeds, which means that there's an oversupply of feed domestically, that's cyclical. We took the view of, obviously, we were pretty comfortable that they freed up capital. We weren't blind to the fact that some of the things that had driven the stock higher was the constant debottlenecking, they called it. So it's increasing the efficiency of these feed mills, because the fixed cost base is so high. You get an extra ton through, you get extra trucks through, etc. You know, you can materially improve your operating leverage. And so, you know, that wasn't running out of steam as such, but a lot of that was in the bank. But we came to the conclusion that the market had capitalised some cyclical earnings issues, and they had a good balance sheet, a very good management team. They'd made some good acquisitions in the past, and they were very open that we want to add another vertical. Now, we had no idea what that vertical was going to look like. They said it was going to be in the ag space, and we think they hit it out of the park effectively with that Dyno Noble acquisition. And it's a classic one of those industrial businesses that probably hasn't been run as efficiently as it could. So when you get a management team like this, who are very good at those, you know, fundamentals of just getting incremental efficiencies out of assets, you know, we think there's a lot of, you know, synergies operationally and financially that we think they can get out of that. So we're pretty happy with it, yeah.
Nice. What would you be watching on the other side? What are you kind of keeping an eye out for that would break the thesis?
I think if they deviated too far probably from that, I think it's if they stepped out of their current verticals to an extent where we couldn't see the synergistic benefit. You know, we're like, I know we can't, you know, it doesn't make sense to us. It might make sense to them, and they're probably smarter than us when it comes to their business, of course. But if it didn't make sense to us, you know, that would probably be a thesis breaker for us. And obviously management is critical there because, you know, you need to be driving those efficiencies. You need to be onto it, and you need to be allocating capital really efficiently. So it would be probably a deviation, I'd say, from like their strategic pillars beyond what we can kind of get anchored around.